Good afternoon, and welcome to our post-election year-end planning webinar brought to you by the Private Client team of Forvis Mazars. Today, we're going to talk about the election results and tax policy, the estate and gift tax exemption that is set to sunset, tax and financial planning ideas, and a market commentary and economic outlook. We have a group of professionals on our panel with different areas of specialty, starting with Rachel Efthemus, a tax partner with our team, Matt Wall, who specializes in investment and financial planning advice, John Davis, who also works with investments and financial planning, and Sheila Christie, one of our regional wealth strategists, who works exclusively with our clients on estate planning. We're going to kick things off talking about the election results and tax policy, and I'd like to welcome Rachel.
Thanks, Holly. So now that we know the election results, that Donald Trump is the president-elect taking office in January, there's a bit more clarity regarding the direction of the upcoming tax policy. If you recall, the tax law currently in place is a result of the Tax Cuts and Jobs Act, also referred to as the TCJA, that President-elect Trump signed into law during his first term as president back in 2017. Some major elements of the TCJA were reducing tax rates for corporations and individuals, increasing the standard deduction and family tax credits, eliminating personal exemptions, reducing the impact of the alternative minimum tax, and limiting itemized deductions, such as placing a cap of $10,000 maximum for the state and local income and property tax deduction. The mortgage interest limitation had a lower indebtedness threshold, and there was the elimination of miscellaneous itemized deductions. The New York Times actually described the TCJA as the most sweeping tax overhaul in decades. Now, most of the changes enacted by the TCJA that went into effect on January 1st, 2018 are set to expire by the end of next year, the end of 2025. A notable aspect of Trump's campaign was to make the current tax law under the TCJA permanent, as opposed to now expiring at the end of next year. In addition to the permanence of the TCJA, he also promised during his campaign to impose steep new taxes on trade, including a universal baseline tariff on all U.S. imports of between 10 and 20%, at least a 60% tariff on Chinese imports, between a 25 and a 100% tariff on Mexican imports, as well as even considering replacing personal income tax with increased tariffs. Some other notable proposals would be lowering the corporate income tax rate from 21% to 20%, and even lowering it as low as 15% for companies that make their products within the United States. He also discussed making tip income, overtime pay, and Social Security income exempt from personal income tax. With regards to deductions, he also proposed a deduction for auto loan interest, as well as reinstating an unlimited deduction for state and local income tax and property taxes, as opposed to the $10,000 limitation, or in effect discontinuing the cap as part of the TCJA extension. Some credits were also mentioned during the campaign, such as a tax credit for family caregivers, and Vice President-elect J.D. Vance also discussed increasing the child tax credit to $5,000. With all of these proposals, some are worried that extending the TCJA tax cuts would not only boost inflationary pressure, but also continue adding to the growing national debt. The Congressional Budget Office estimates that extending the expiring provisions would add an estimated $4.6 trillion in deficit over the next 10 years. So it'll be interesting to see how this plays out now that Republicans control both the House and the Senate.
Rachel, that's a helpful reminder of the current tax law and sets a great foundation for our discussion today. So I have a question. If TCJA is not extended, what changes will taxpayers see in 2026?
Yeah, so if it's not extended, the tax rates for individuals would increase both within the tax rate brackets. So more income would be taxed at the higher marginal rates incrementally, as well as the top individual tax rate would increase from the current 37% top tax rate back up to 39.6%. The corporate tax rate would remain unchanged at 21%, but the qualified business income deduction of 20% would be eliminated. The individual standard deduction and child tax credits would also be cut in half, and there would no longer be that $10,000 cap on the deduction for state and local income and property taxes as an itemized deduction. The mortgage interest deductibility threshold would increase from the current $750,000 threshold back up to the $1 million threshold. And miscellaneous itemized deductions would once again be deductible if they exceeded 2% of adjusted gross income.
Okay. So before we get into the specifics on Congress, can you give us a brief background on the formal tax legislative process so that we can all have a better understanding of the viability of these proposals becoming actual tax law?
Absolutely. I think it's good to have a good background so that they understand the whole process. So the formal tax legislation is the process by which a proposed tax rule may become law in the United States, and it follows specific steps defined in the U.S. Constitution. Tax legislation, like all other federal laws, require consent of both houses of Congress, the Senate and the House of Representatives, as well as presidential approval. Now, according to the Constitution, all tax legislation must originate in the House of Representatives. So the process actually starts when a tax bill is proposed to the House for consideration, and then it's referred to the House Ways and Means Committee. Once the committee members reach an agreement regarding the legislation, the proposed tax law is written and goes to the full House for debate, amendment, and approval. If the House approves, then the tax bill is passed to the Senate, where it's then reviewed, and the Senate Committee on Finance may rewrite the proposal before it's presented to the full Senate. Following Senate approval, the tax bill is then sent to the Joint Committee of House and Senate members, who work together to create some version of a compromised plan. And then that compromise version is sent to the House and Senate for approval. Once Congress passes the bill, it's sent to the president, who will either sign it into law or veto the bill. So if the president signs the bill into law, then the responsible agencies, such as the Treasury Department and the IRS, must carry out the laws of the bill. However, if the president decides to veto the bill, it's then returned to the House along with the comments and the statements regarding why the president opposed it. And then they have the ability to make changes based on what the president has provided and either make the changes that the president wants or override the veto if they have 2/3 of a vote in each house, in the House and the Senate. So if they're successful, the tax bill would become law without the signature of the president. Presidents can, and frequently do, recommend changes to current tax laws, but only Congress can make those changes.
Okay. So would you also describe the main differences in structure and process between the House and the Senate?
Sure. So the House has 435 members, whereas the Senate has only 100 members. The term limits are also different. So within the House, the term limits are 2 years versus 6 years of term limits in the Senate. Each have tax committees, which are the House Committee on Ways and Means and the Senate Committee on Finance. And both of these committees greatly influence, if not control, the progress of tax legislation. A simple majority is needed to pass legislation in both the House and the Senate. However, there is unlimited debate possible in the Senate. So this is also known as a filibuster. And this can be avoided with a 60-vote supermajority.
And sometimes we hear that individual senators have more relative power to influence legislation passage than House representatives. Is that true?
So Senate consideration can be lengthy and can even be a dead end for much legislation due to the availability of that filibuster and lack of restrictions on amendments. Since the Senate has the ability for unlimited debate and amendment, it's possible that individual senators may wield more quote unquote power and influence over specific legislation.
All right. So let's discuss the changes in control of the House and Senate post-election and how that affects the process and use of things like the filibuster and reconciliation bill.
Okay, the Republicans now have control of both the Senate and the House. The focus will likely be on some moderate Republicans like Collins, Murkowski, and Young that provide pivotal votes in the Senate and could make things difficult for Republicans. In the House, some critical votes may depend on members' concern with the growing national debt, as mentioned earlier, rather than continuing the current tax relief. The passage of Trump's continued and additional tax cuts could be difficult because the proposals are viewed as costly without many revenue generators. This could put big ticket items in jeopardy, like the increased estate and gift tax lifetime exemption, 100% bonus depreciation, and others that are big revenue generators.
Okay. Now, given that Republicans don't have a 60-seat supermajority in the Senate, is there any way to avoid filibuster and get any tax laws passed?
Yes. So there is actually a workaround through budget reconciliation and the use of reconciliation bills. But practically speaking, reconciliation bills are unlikely to be successful unless the president, the House, and the Senate are all of the same party. Given that will be the case in January, reconciliation bills seem to be a likely option and only need a simple majority for consideration and passage in the Senate, unlike non-reconciliation bills. So reconciliation bills can be used for changes in spending, revenues, and the federal debt limit. Only mandatory spending and not discretionary spending can be considered via reconciliation bills, excluding items otherwise considered in the appropriations process, and debate on reconciliation bills is limited to 20 hours. There's also something called the Byrd Rule, which provides a sort of check to the reconciliation process. Essentially, the Byrd Rule stops senators from adding provisions to the reconciliation bill that aren't related to its core purpose, generally disallowing items that do not affect outlays or revenue. The Byrd Rule also prohibits initiatives that would increase the deficit beyond the fiscal years covered by the budget resolution. So some recent examples of tax legislation passed by the use of reconciliation bills are the TCJA back in 2017 and the Inflation Reduction Act of 2022. So I'm going to turn it back over to you, Holly, for our first polling question.
All right. Thank you, Rachel. I think that provides a great broad understanding of where we are today. I will add that we have a link here in the webinar profile that sends you to, it's called How Things Work, our tax policy resource guide. It is an excellent guide to read through, especially if you enjoy the strategies that can go on here over the next really year to year and a half here as we watch what happens, and something that you can go back to and reference as you think about what might be happening in Washington. So I would encourage you to download that guide. But now we'll get to our polling question. Which tax policy would you like to see enacted? A, 100% bonus depreciation. B, permanence of increased estate and gift tax exemption. C, tariffs. D, immediate deduction of research and development expenses. So we'll give everyone a minute or so here to answer that question, especially for those of you that want to make sure you get CPE credit. I know I did see in the questions there, how does the bill become a law and do all bills become laws? And again, there's a lot there that unfortunately we don't have enough time here today to get into all those details. But if you go to our tax policy resource guide, I think you'll enjoy it. And it's an easy read and has FAQs in there and something that you could continue to reference. So there's another question here too about if tax-free tips get any traction, is it likely to also eliminate the restaurant tip credit? I do not know that necessarily off the top of my head, Rachel, and if that's something we maybe need to watch for, or we can get back with the attendee on that question.
Yeah, I think it's to be determined to see if what happens if they indeed exempt tips from taxable income.
Okay, yeah, great. That makes sense. So, okay, well, it looks like it's a pretty close tie here between the bonus depreciation and the permanent increase of the estate and gift tax exemption. So we'll see how this goes. And now I'd like to bring Sheila Christie on to talk about the estate and gift tax exemption sunset.
Thanks, Holly. I appreciate everybody being here today. And while I may start out by saying, yes, 40% of us would like to see permanence, but it's not going to happen, I do have some good news for us too. So I want to start a little bit back and let's talk about before the election, what were we talking about with the estate and gift tax exemption? And just at a basic level in our government system, we have what are called transfer taxes. Those are the gift tax when you give something away over life that's over that annual $18,000 you can give. The estate tax, which is on the transfer of your assets at death. And then there's a generation skipping tax, which is when you skip multiple generations, there's a tax on that as well, potentially. Now, the big thing about this tax is it's 40%. So it is a big tax. And in recognition of the size of that tax and how it's essentially a tax on your assets and your wealth that you've built, the government has given us some leeway and some amount that is exempt from that taxation until you reach over that amount. Now, 30 years ago, plus when I first started the practice of law, got into law, that exemption amount that before taxation was $600,000. It was not high at all. We are now at 30 plus years later at a historically high exemption amount. This year, it is $13.61 million per person or $27.22 million per married couple. And it will become important. Sometimes I'll point out the married couples because they have some few extra tips and tricks that they can work with to make sure that both their exemptions are used, even if one spouse does not have that much money and the other spouse has more than that. So we've gone from over the course of decades from the 600,000 to now 13.61, and there has been upheaval probably every decade. Estate planners, wealth strategists, anybody in this industry has been dealing with sort of the political upheaval that leads to the tax upheaval in this system of transfer taxes for quite some time, including 2010 when there actually was no estate tax. And that was some serious changes in the system. However, where we are now is that it's 13.61. And as Rachel mentioned, though, it is part of the Tax Cut and Jobs Act of 2017. And that 13.61 is set to sunset, to go away at the end of next year. And when it does, it's going to revert back to the pre-2017 amount, which was $5 million, plus adjustments for cost of living, inflation, things like that. So we think it's going to revert back on January 1st, 2026 to about $7 million. So right now, between today and New Year's Eve next year, there's an opportunity with $7 extra million to give away during your lifetime without any taxation in the transfer tax system. And that's a huge opportunity. So the next question then becomes, well, wait, how's the election going to change that? How, if the TCJ Act was under the last Trump administration, won't we go permanent in the new administration? And for a lot of the reasons that Rachel's already articulated, it's going to be very difficult to do that. So what we do know is, again, this year you can give $18,000 to anybody with no tax consequences for gift and estate tax. You can give away $13.61 million without any of these tax consequences. We do have the numbers for 2025. Next year, it'll be a $19,000 annual gift and a $13.99 million lifetime exemption that you can give away, which really, that's about $28 million per married couple. That, again, will be reduced to $14 million. So this $14 million freebie, use it or lose it, will go away probably at some point. So where do we stand at post-election? We do know that with Republicans in both houses and in the White House, there's certainly more political will to maintain, extend, or make permanent. However, for the same reasons already mentioned, it's very unlikely that it can become permanent. It's a huge tax cut or tax benefit that, as Rachel mentioned, I think it's $4 trillion over 10 years if everything was made permanent or kept where it is from the 2017 law. Also, as she mentioned, we've got Senate filibusters and we've got budget reconciliation processes. And if it's important to remember here too, if nothing is done, it happens. It's not like anybody has to act to make this sunset happen. The sunset's going to happen unless people act. And that gets us to sort of the political will, which Rachel discussed a little bit too, that without having a supermajority and having a fairly slim majority, there may not be the political will to push through even an extension to this sunset. When we talk about all the other things mentioned, getting rid of taxes on tips, Social Security, overtime, the state and local tax deductions, those are a lot of campaign items that came up and were repeated. I personally only heard once in the whole campaign trail that they wanted to make these permanent. It just was not a very popular speaking point, which makes one wonder, is there a lot of public will or political will to get this done? When you add in moderate Republicans and those worried about our growing debt, which this would add to, it may be really difficult to even get an extension. And it's just improbable from a cost prohibitive perspective that this could become permanent. So where we are post-election is pretty close to where we were pre-election, which is you need to plan that in a year or so, $7 million is going to be lost, use it or lose it, and you won't have the ability potentially. Could that go down another year? Could they extend it and say, hey, we're going to give everybody a breather and give you 18 more months now that you're aware of it? Sure. But that's just kicking the can down the road. And you don't want to kick your can, you don't want to kick your plan down the road because that ultimately costs you more in the end. And so that's sort of what I wanted to talk a little bit more about, is that while certainly some things could happen politically, I don't believe this will be a case of huge upheaval. And it may very well be that their other prominent pledges just take up the whole year. And it may be that if there's only a year left, will they even be able to get it done in a timely manner? So there's a lot of considerations that just lead us to this probably will not become obsolete or become permanent. So again, use it or lose it. If the government's going to give you some freebie to use without tax, my gosh, we should use it, right? And why use it today? Why not wait a year, 18 months, 2 years, see how it kind of plays out, right? Time is money. That's why. And a lot of the planning techniques we use take advantage of this idea that time is money. And I'll give you an example of how. So a big technique we use during times like this, where we're trying to shift wealth down to somebody else's balance sheet for looking forward to death. At these times, we use things called estate freeze techniques. And that basically means let's lock in an amount of your gift, take it off of your exemption, and then all the growth that comes from that, all the appreciation on that gift is off your balance sheet. It's on your beneficiary's balance sheet. So for instance, you have a $10 asset today. You decide tomorrow to give it to your child. It grows to 50 in value in 5 years. Well, that 50 is on their balance sheet, and it only cost you 10 of this exemption that you get. So there's a lot of value there in having that growth and appreciation out of your estate, and you're kicking those taxes to a later date because now that 50 maybe grows to 150 by the time of your death. Doesn't matter. That 150 is on your child's balance sheet, and it doesn't get taxed for estate tax until your child's death. And in some of our planning techniques, we can push it down another generation so it's not taxed until your grandchildren's death. So I like to say now, don't kick the plan down the road, kick the tax down the road. And that means doing the plan now. So let's say you're again like, let me just wait a couple of years. I just want to see how this all plays out. It's a little hectic right now, a little bit of chaos right now. Well, what if you wait 2 years and you find out, well, A, they only gave us a 1-year exemption or extension on the exemption. So gosh, now time is of the essence again. And now your assets worth 30. Say the market's been doing great. So your assets worth 30. So you've lost the value of getting that 20 in appreciation that's now on your balance sheet off of your balance sheet early. So now you're going to have to use 30 of your exemption, and that may cost you being able to use that exemption elsewhere to do other neat tricks and techniques to move it off your balance sheet. So you're going to have to use 30 to get that down to the next generation. Again, whatever it grows to, gosh, if it's 150 at your death, that's still great. You've got 120 off of your balance sheet at death. But you had to use 30 when you could have used 10. So that's one of the reasons why it's like, just keep going. Just keep going the way you've been going, thinking that the sunset's going to happen. Because again, it's going to happen. It's just, when is it going to happen? The other reason time is of the essence is none of this happens overnight. You may want to give away 10, but do you know if you can? How's that going to affect your cash flow? Because we're talking about giving it away now. Does that impact your retirement ideas? How's that going to transition to your children? Do you want to put some parameters on it, some strings attached? Do you want to deal with the grandchildren now? Should you somehow work this in with super funding of 529? Well, how does that impact your annual gifts? All of these questions make up your estate planning choices, and they take some time to work through. And once you've worked through making sure that everything's going to work for you, your family, your business, your philanthropy, your values, and what you want to transition down, once you've gone and done all of that, it's going to take you a year, 18 months, 2 years. So that's another reason that time is of the essence to get it moving. Because then once you've got this whole beautiful plan, you're going to have to implement it and you're going to have to execute it. And that also takes time. So you really, kicking the can also is just going to put more pressure on you to get things done quicker down the road. And attorneys are already warning that they're booking up. And I don't think that's going to change, because I don't think there's a grand belief that things are going to become permanent in this area. So you may say, okay, great. All right, I'll just keep going like I'm going. I don't even understand what my plan says. That's perfectly fine and perfectly common. As a recovering attorney, I know I certainly probably sent some folks away with an understanding in the moment, but maybe not an understanding 5 years later, right? That's where we can come in and really assist. We have what's called we call an estate plan mapping and analysis, where we can say, here's your documents. Let's put them in understandable form, some diagrams, some words, and some numbers to show you, here's your tax impact. Here's how it's going to affect your family. Here's what we see it doing to your business. Here's how we see this being affected today in 2024 and after the sunset. So you have numbers and hard points of, oh, wait, my son is getting this, but my daughter's not. And you realize this when we map out what's going on. And so from there, you can really build that out into a robust, full strategy to say, all right, I've got this amount of time. What am I going to do to use this freebie, use it or lose it from the government? And work that within your whole plan to make what modifications and changes you should. You may also be in a place where you say, I haven't even started to plan. I don't even know where to start. That's also great. Come see us. We do all manner of planning. And what you need to do then is really get started soon. Because what that means is you're starting from scratch. There's tons of great ideas. There's tons of great techniques. But again, they all take a little bit of time. And I think that one of the biggest strengths that we bring is that we look at all holistically to make sure, again, that it works for everybody, that it's not going to impact your way of living. It's not going to give you more risk than you're willing to take. It's not going to transition funds to your kids that you don't think are ready to handle it. You know, all of these big life issues and small life issues come into play, as well as the numbers. And we like to make sure that the plan fits you exactly. It's a plan for you. and only you. And everybody's estate plan should be that way. So all in all, we're not really in any different place post-election, other than there may be some extension of this exemption. So otherwise, you should be looking to use your extra exemption amount that we anticipate is going to go away sooner than later. And we'd be happy to help you figure out how to do that. With that, I'll turn it back to Holly.
Thank you, Sheila. Those are some great thoughts and ideas for our attendees to consider. And I think really that you hit on it is that it's a use it or lose it. And it's, I like the time value of money example, because even if they extend it permanently and it continues to index for inflation, time value of money, get it out sooner rather than later, if that makes sense for your family's plan. So that's great. Thank you. We'll go to our next polling question, especially for those of you looking for CPE. Who do you coordinate your estate plan with? A, my attorney, B, my investment advisor, C, my accountant, or D, my family. So,
and Holly, here I would butt in briefly to say, I think this one's a trick question because it should be all of them. So
that is
your best plan. If your estate plan deals with your whole life, then everybody, all your trusted advisors in your whole life should be part of your estate plan, including your family, who's probably a beneficiary of it. So from my perspective, that may be a slightly trick question.
I like that. That's great. We should have had E for all of the above. So we'll wait for that result. I did see a question in here, Sheila. It asked if we will continue to have portability after the sunset.
That is anticipated to continue. I do believe that I haven't heard hide nor hair, honestly, about anybody going after that. So I do believe that'll remain for sure.
Okay, thank you. Okay, and it looks like we have our results topping out with the attorneys and then about equal down below. We're a little heavier with the family. So I think you made a good point there, Sheila. People are in agreement with you. Yeah. All right. Well, thank you very much, Sheila. And now we will move on to talking about financial planning and income tax planning that you might consider by the end of the year. So I will turn it over to John.
Thanks, Holly. So I am going to talk about a few financial planning tips and strategies you might consider here before the year wraps up. So the first couple that I'm going to talk about tie into each other a little bit, but two-step Roth contributions, or you might have also commonly heard of them termed as backdoor Roth contributions. What that strategy entails is making non-deductible traditional IRA contributions and then converting into the Roth IRA where you have tax-free growth and then down the line tax-free distributions. And where this tends to make the most sense is for individuals that are higher income earners and may not be able to make Roth contributions through the direct traditional route. The one thing that's important to consider with the two-step Roth contribution is that you want to make sure you don't have a existing traditional IRA, because that can impact the taxability of the two-step Roth contribution. The other piece of that you might consider that's similar but a little bit different is just straight Roth conversions. So Roth conversions, similar to the two-step Roth, you're taking money in a traditional IRA, converting it over to the Roth, but with the traditional Roth conversion, that is a taxable event. And so that's going to make more sense for somebody that is in a lower income tax year, or they anticipate the years to come to be higher income years and therefore want to pay that tax now as opposed to potentially paying at a higher marginal rate in the future. As we get closer to the end of the year, charitable giving might be more on the mind of individuals. We have Giving Tuesday coming up here in a couple of weeks. And there's many strategies you can utilize to gift in a more tax efficient manner. The one that I wanted to focus on today is the charitable bunching strategy with the donor advised fund. So this strategy, think of it as preloading your charitable giving. contributing several years worth of donations into that donor advised fund. And if you're not familiar with the donor advised fund, it's similar to the 401k, in that you're making contributions into that account that can grow for charitable purposes. And when you deem to make those grants from the donor advised fund to a 501c3 charity, they can be done so tax-free to that organization and to yourself. So in order to utilize this strategy, let's use the example of an individual that maybe they do on an annual basis $5,000 of giving, and they anticipate continuing to do that into the future. In a normal year, they may not be able to capitalize on that gift to the charity because they might be utilizing the standard deduction. By bunching, you do 5, 10, however many years in advance, so say $50,000 of gifting all at once to that donor advised fund, getting the credit for that contribution in the current year the gift is made, and then the funds themselves, once in the donor advised fund, can be distributed out over whatever period makes sense, or to whatever organizations that you deem to be beneficial in that given year. So this is a great way to maximize tax deductions for gifting you're already doing, and it's a way for you to be strategic in years to come with those gifts. And the other thing that makes this strategy even more effective is when you're able to use appreciated securities. So you can't use cash as a contribution to the donor advised fund, but if you're able to use appreciated securities, you're actually able to avoid having to sell that security, realizing the gain, and paying the tax on that as well. Moving on to some investment-related financial planning considerations. One is loss harvesting. So just with the way the market's moved over the last couple of years, good problem to have. There's a lot less losses out there. So about everything has gone up over the last 2 years. And as we get closer to the end of the year, it is good to take stock of where you are year to date. If you've realized gains in the year, are there opportunities to harvest losses in securities that you own? Understanding the idea of investing isn't to lose money, but there will be periods of time where the value of the security you own is less. And can we sell that security, capture that loss, use it to offset any current year gains or future year gains, and then get that money put right back to work without incurring any wash sale bills? We don't want to put that back to invest it in the same exact investment. We either want to wait the 31 days or put it in a different investment. On that note as well, one thing, if you use actively managed mutual funds, these funds will make trades under the hood all year long, and they are required to pay out a portion of the gains they realize within the fund by year end. And so a lot of these funds will do so in the first few weeks of December. And so it might be worth considering selling out of that fund before it pays that gain, even if there is an embedded gain within that fund. Lastly, the thing that I'll mention on the investment front is about asset location. And this is probably one of the most commonly underutilized strategies when looking at a portfolio building. And the idea is putting assets in the most tax efficient buckets. And so for an example, if you have a Roth IRA, that, like I mentioned before, is an account type that you'll have tax-free growth on top of, in the future, tax-free distributions. And so that might be an account where we want to prioritize growth. And so we might want to have more stock or growth-oriented securities. So whereas in a taxable account where we're getting taxed every year on dividends, interest, and capital gains, we might want to use more tax-efficient vehicles like individual stocks or stock ETFs or index funds, or even municipal bonds if we're looking at more fixed income. The real idea with this strategy is, in investments as a whole, it's not about what you make, it's about what you take home after taxes. And I want to pass it back to Rachel here to talk about some tax planning strategies you can consider here before the end of the year.
Great, thanks, Sean. So some things that you want to consider, and these are just some ideas, they're not exclusively all ideas, but some important things to do would be to review your withholding on wages to confirm that it's adequate. So, you want to be sure that you're including anything like year-end bonuses that might be withheld at a different rate, or increase your income over your normal wage income, or things like any business distributions that you may not have withholding on, so you may have to supplement the paying the tax liability on that type of income with some estimated tax payments. So we sometimes see a shortage in this. You know, if you're not reviewing it and you're not on top of it and you don't understand, there could be estimated tax interest and penalties owed on this. And that's really what you want to try to avoid, because you don't want to pay extra to the government if at all possible, over and above your actual tax liability. So one example is you have your regular wages and withholding, and your employer is withholding only based on your compensation, but you may be a married individual, so your effective tax rate with your spouse may be higher than the withholding rate at your employer. So say your employer's withholding federal tax at 20%, but your combined effective federal tax rate with your spouse may be 37%, the highest tax rate. Now, if you're not monitoring that, you're going to come to the end of the year, you go to file your taxes at the beginning of next year, and you see, oh my goodness, I have a 17% shortfall on my withholding on all of my income now, because my effective tax rate is essentially almost double what my withholding rate was at. Now, if you don't have the minimum amount paid in, 90% of your tax liability paid in throughout the year, you will be subject to some of these interest and penalties for underpayment of estimated taxes. So that's just something you want to monitor so that you can avoid those penalties. And if you need to supplement with estimated tax payments for either a shortfall on withholding, or again, income that may not be covered by withholding, such as investment income or some business like self-employed business income, you want to make sure that you're paying those in quarterly to avoid any estimated interest and penalties. Some other things you want to review just to make sure that you are taking full advantage of your benefits. So if you have any dependent care benefits, medical flexible spending accounts, or health savings accounts, you want to make sure that you're utilizing those before year end. So always a good time, especially now if you haven't done so already, take a look at those, see if there's anything that you need to do before year end to utilize your maximum benefits so that you don't lose any of those. Another item where you can take advantage is with 529 plans. So those are college saving plans, and many states have their own separate college savings plans, and then different states have different maximums that you can contribute, or the maximum deductions that you can take at the individual level. So you want to be sure that you're aware of, number one, does your state have a plan? Does it allow a deduction for resident state plans? If so, is there a maximum limitation on that deduction? Just again, you may not be able to maximize, but at least being aware and knowing what it is. If you are able to do that, that way you can take the benefit of maximizing that deduction before year end. Another thing you would want to look at, and I think, in my opinion, this might be one of the most important, is reviewing any carryovers that you might have. So not all carryovers, such as carryover losses or charitable contribution carryovers, not all of them are for an unlimited time, right? So charitable contributions is a great example where if you contribute to charity in any given year, you're limited at different levels. If you're contributing cash or if you're contributing appreciated stock, there's different limitations based on your adjusted gross income of how much you can take as a deduction in the given year. So if you have given over and above that, you don't lose the deduction in the current year. You can carry it over, but only for 5 years. So I have a situation now with a client who had donated appreciated stock, and this year coming up in 2024 is the last year that they can take this carryover deduction. So we're looking at, is there any way that we can shift and maybe accelerate income in 2024 so that they get more of the benefit and they're not losing some of that carryover, charitable contribution carryover that's going to expire at the end of 2024. And again, it's sort of a give and a take. You want to look at it and analyze it. It's not always black and white, because it may not make sense to accelerate the income, but there may be some type of break even where you're going to maximize the benefit and minimize your tax liability. So just something to keep in mind. And there are certainly other carryover losses that you want to consider, net operating losses, to be able to offset other type of ordinary income if possible, passive activity losses, capital losses. Again, with the capital losses, that may be something, if you have a carryover, to look at, is there something that I want to do in my portfolio where I might be able to recognize gains potentially to utilize those losses this year? That makes sense from an investment perspective, maybe rebalance my portfolio, certain things like that. So definitely something that you want to, just like with the estate and gift tax planning, you want to consult holistically with your financial advisor and your accountant.
Thank you, John and Rachel. Those are all great tips and highlights. And as you mentioned, not all inclusive, but just great reminders to spark the conversation and accelerate some of those decision making, maybe even before mid-December. Because I know, as you mentioned, the charitable contribution carryover is important, but also knowing that a lot of the custodians want to make those gifts of appreciated securities usually by about mid-December. So I feel like that year-end tax planning is a little bit accelerated these days. So we'll go to another polling question here. Which of these areas of planning have you not really thought about or given adequate attention to? A, retirement planning, B, estate planning, C, income tax planning, or D, investment and insurance planning. So we'll give you a minute to think about that and answer that question. I'm going to check and see if we have any questions that we need to answer. Not right at this moment.
Somebody had a question related back to the estate and gift tax, and I thought I might answer that real quick while people are polling. The question was, does a gift made in 2024 come off the top of the exemption? And the answer is, it depends. If it is the $18,000 2024 annual gift, no, that is above and beyond the exemption. There's also some other small ones, paying medical bills directly to a hospital, paying tuition directly to a school. However, if you're doing anything above and beyond just those annual items, that will come off the top of your exemption. Your exemption is for use during your life or at death. So it's just kind of comes off your tally. So if you made a $1 million gift in 2024 on top of the 18,000, that would be $1 million that would tally off of your exemption. Exactly. So hopefully that helps.
Yeah, thank you, Sheila. Okay, and our results are in. The areas that maybe need some more attention. The first one is estate planning, which is interesting, as we know we have potentially a timeline here of the end of 2025. So that's good that you're at least aware that maybe that you haven't given enough attention. And then investment and insurance planning is a close second there. So, all right, thank you. I am going to turn it over to Matt Wall now to give us the market update and economic outlook.
Yeah, Holly, thank you very much. And generally the way I like to think about the market or explain it to our clients is it's not that the U.S. economy is great or terrible, it's just okay. And we would tell you that the economy was okay before the election, and we would tell you that the economy is going to be okay after the election. And part of the reason that's important to keep in mind is if you think back to 2022, we were supposed to have a recession that year, and then we were supposed to have a recession in 23, and then we were supposed to have a recession in 24. And depending on what financial news you look at, you could argue that somebody somewhere is saying we're supposed to have a recession in 25 as well. But part of the reason we haven't is that the U.S. economy has continued to grow. And that economic growth has been between 2 and 3%. Most recently in the third quarter, it was about 2.8%. And part of that is because of consumer spending. Consumers make up about 70% of the U.S. economy, and they've been pretty consistent in their spending habits. That's allowed the economy to be a little stronger than expected. Also, some of the good news is that inflation has continued to moderate. In October, it came in at 2.6%. This is a little higher than where it was in September at 2.4%. But again, you got to remember that in 2022, that number was closer to 8 or 9%. So much lower than where it was. And because inflation has moderated, that has allowed the Federal Reserve to start to lower rates. So they cut short-term rates by 50 basis points in September. They did another 25 basis points in November. And that's expected to continue as we go into 2025. And so when you think about those things, just that general good backdrop for the economy, it's not an economic presentation without a chart. So here's one with lots of lines. If you look at the top, that's U.S. stocks. They've had the best year to date. This chart goes through September 30. The green below that is international stocks, and then bonds are down below. If you go forward a little, again, since this one goes through September 30, through yesterday, U.S. stocks are up 25%. International stocks are up about 7%. Bonds are up about 3%. So really, it's a positive backdrop for most asset classes. And interestingly, since the election, so the day after the results came out, U.S. stocks have been up about 2.5%, and international stocks have been down about 2.5%. So those have kind of offset each other. But at a high level, when the presidential election is over, we always expect kind of the market to rally a little bit after that. So if we think about moving into 2025, kind of what the investment outlook looks like, again, we think kind of things are okay. The economy is forecasted to grow at a solid pace next year. When we think about profits for the S&P 500, right now those are expected to be about 15% growth for the year. Now, you do have to keep in mind that the analysts, they start a little more optimistic. So it's 15% today. It's probably going to be 10 to 12% as we go through 2025. But in general, we're looking for growth next year. The Federal Reserve is expected to continue to cut rates. That's generally supportive of multiple asset classes. And productivity has been high as well. So if all those things keep up, it gives a pretty good outlook for next year. There's always some things to be worried about. One of those is that when you think about the valuation of the U.S. stock market, it's a little more expensive than average. So that would tell you that when you look forward, it's not necessarily that stock returns have to be negative. It's just that if the long-term average returns are 10%, you would expect something less than that, kind of when you start with valuations at a higher range. And if you just think specific to the election, some positives, with the Republicans in control, the general idea is you'll have less regulation. So generally that's good for the market. Some of the cautions, the things we just don't know about yet, are what are the tariffs going to look like? What is immigration policy going to look like? What does that do for the labor force? So certainly there's going to be some things to look at next year, but in general, a positive backdrop. But I do think because of where we are with the election just ending, it's worth taking a look at this chart. I find this one very interesting from kind of a psychological perspective. This is consumer confidence. So the red line is what Republicans report as their consumer confidence. The blue line is Democrats. And then if you look at the very bottom, sort of when you see the red, that means you have a Republican president. When you see the blue, a Democratic president. And kind of what's interesting with this is that we're all human, we're all emotional, and we let that political lens can change our view of the world. And so when you have a Republican president, Republicans tend to have a more positive outlook on the economy. And when you have a Democrat president, Democrats tend to have a more positive outlook on the economy. And why this is important is if there's clients that had cash on the sidelines before the election, now that it's over, our clients that were happy with the election, they might want to be a little more aggressive, right? And we may have to pull them back just a little bit. And then maybe our clients that weren't as happy with the election, they may want to be more conservative. And we're going to have to push them a little bit to get invested. And the reason this all matters is the last slide here is about 70% of the time, right? Stocks tend to go up, about 30% they go down, but they're agnostic as to whether it's a Democrat or a Republican. In the presidential seat, the market tends to go up over time. So you got to be a little careful if you let that political lens impact how you view the world and how you view your investments. And with that, I think we'll go to the last polling question.
All right, thank you, Matt. I'll read this next polling question, and then I know we've got a couple questions here in the list here. But it says, would you like a Forvis Mazars professional to contact you and provide more information on one of the following topics? A, yes, I'd like more information on the estate and gift tax exemption sunset. B, more information on tax and financial planning. C, more information on the market and economic outlook. Or D, no, thank you. So we'll let you answer that to make sure you get your CPE credit. I will say I want to thank all the presenters. I think a client and counsel of mine told me years ago, it's been a good meeting if you've met someone new, introduced two people to each other that didn't know each other before, or learned something new. So hopefully you learned something new today, or your memory was jogged with something that maybe you need to do before year end, and that we've helped you with maximizing your opportunities here before the end of the year. We do have a couple minutes, so if people need to leave, we understand. But I saw, Sheila, a question came back in about the lifetime exemption, and just a little bit more detail of an example of how you manage that.
Sure. And so if going back to the example of there's $1 million gift in 2024, that you will file a gift tax return in 2025 for 2024 that says, I have 13.61 and I've used 1 million, so now I have 12.61. Now, when that reduces, it will not reduce. We do not believe that when things revert after the sunset, they're not going to penalize that million onto your lowered amount. So using that exemption amount now, it will stay out, stay gone, and not count against the lowered exemption later. But right now, it is sort of throughout the course of your life, you have this 13, soon to be $14 million. And if you take $1 million off, then you're going to report you've got 13 left. So I've had clients who maybe 10 years in a row, we did significant gifts. And each year we just file a gift tax return, Form 709, report the gift, reduce our lifetime exemption. So, but the big thing will be, well, how far down will it reduce it when the sunset happens? And we don't think that it'll come into play in that if you're using that 7 million, that will not impact the 7 million that's going to remain, if that makes sense.
All right. Yes. Thanks, Sheila. I know it can get a little hard to explain without having a whiteboard maybe to work through the math, but I think that made great sense. So thank you. Thank you very much. In the interest of time, I think that we will close this out for the day and thank everyone for attending. Hope you have a great holiday week next week.